In this section, we will explore how AU stocks rally is leaving behind smaller companies, a sign that investors may be bracing for economic turmoil ahead. Small-cap stocks are those with a market capitalization of less than $2 billion. They tend to be more sensitive to changes in the domestic economy than large-cap stocks, which have more global exposure and diversification. Small-cap stocks also rely more on borrowing from regional banks, which have been hit hard by the recent banking crisis. According to Reuters, the small-cap Russell 2000 index is down about 1% this year, compared to a rally that has boosted the S&P 500 index, which represents the largest U companies, by 7% year-to-date. This divergence reflects the growing concerns among investors that the U economy is heading for a recession, as evidenced by other indicators such as the inverted yield curve and the strength in gold prices. One of the main reasons for the underperformance of small-cap stocks is the turmoil in U regional banks, which erupted in early March after a series of defaults and frauds by some of their borrowers. Regional banks are more heavily represented in the small-cap index than in the large-cap index, accounting for some of their weakness. Moreover, regional banks are a vital source of funding for small businesses, which make up the majority of small-cap companies. If regional banks tighten their lending standards or face liquidity problems, small businesses will suffer from reduced access to credit and higher borrowing costs. According to a survey by the National Federation of Independent Businesses, 67% of small business owners use a small or regional bank, 17% use a medium-sized bank while 14% use a large one. The survey also found that 31% of small business owners reported lower earnings in April, while only 16% reported higher earnings. The survey's optimism index fell to its lowest level since November 2022. Another reason for the lagging performance of small-cap stocks is the impact of trade tensions and tariffs on their profitability and competitiveness. Small-cap companies are more vulnerable to trade disruptions than large-cap companies, which have more resources and flexibility to cope with changing market conditions. Small-cap companies also have less pricing power and lower profit margins than large-cap companies, which makes them more susceptible to rising costs and shrinking demand. According to Bloomberg, small-cap companies have seen their earnings growth slow down significantly in recent quarters, while large-cap companies have maintained their momentum. In the first quarter of 2023, small-cap companies reported an average earnings decline of 3.4%, while large-cap companies reported an average earnings increase of 6.1%. Analysts expect this trend to continue in the second quarter and beyond. In summary, small-cap stocks are lagging behind large-cap stocks in the U market, as investors anticipate a slowdown or a recession in the U economy. The main factors behind this divergence are the banking crisis that has hurt regional banks and small businesses, and the trade war that has hurt small-cap profitability and competitiveness. These factors are likely to persist or worsen in the near future, which could widen the gap between small-cap and large-cap performance. The banking crisis that has rocked the U.S. economy since March has taken a heavy toll on small-cap stocks. These are companies with a market value of less than $2 billion, which tend to be more sensitive to domestic economic conditions than larger firms. In this video, we will explore how small-cap stocks have struggled since turmoil in U.S. regional banks erupted in early March, with the Russell 2000 index down 7% since March 8. The Russell 2000 index tracks the performance of 2,000 small-cap companies in the U.S. It is widely considered as a barometer of the health of the U.S. economy, as small businesses account for about half of the nation's GDP and employment. However, the index has lagged behind the S&P 500 index, which represents the largest U.S. companies, by about 8 percentage points this year. One of the main reasons for this underperformance is the banking crisis that has shaken the confidence of investors and consumers alike. The crisis began when First Republic Bank, a San Francisco-based lender that caters to wealthy clients, announced that it had sold $2 billion worth of risky loans to hedge funds and other investors at a steep discount. The move triggered a wave of panic selling among other regional banks, which feared that they would face similar losses on their loan portfolios. Regional banks are banks that operate in a limited geographic area and focus on serving local communities and businesses. They are especially important for small-cap companies, as they provide them with access to credit and capital. However, regional banks have been under pressure from several factors, such as low interest rates, rising loan defaults, increased competition from fintech firms and stricter regulations. The banking crisis has exposed the vulnerabilities of regional banks and their borrowers. Many small-cap companies rely on regional banks for funding their operations and growth plans. However, as regional banks face liquidity and solvency issues, they may tighten their lending standards or reduce their loan availability. This could hurt the cash flow and profitability of small-cap companies, especially those in sectors that are already suffering from the pandemic-induced slowdown, such as energy, retail and hospitality. Moreover, the banking crisis has also dampened the sentiment of investors and consumers towards small-cap stocks. Investors may perceive small-cap stocks as more risky and volatile than large-cap stocks, given their lower liquidity and higher leverage. They may also demand a higher premium for holding small-cap stocks, which could lower their valuations. Consumers may also reduce their spending on goods and services provided by small-cap companies, as they become more cautious about their financial situation. The banking crisis is not only a threat to small-cap stocks, but also to the U.S. economy as a whole. Small businesses are vital for innovation, job creation and economic growth. If they fail to survive or thrive in this challenging environment, it could have negative consequences for the recovery and the long-term potential of the U.S. economy. Therefore, it is crucial that policymakers and regulators take swift and decisive actions to contain the banking crisis and restore confidence in the financial system. Some of the possible measures include providing liquidity support to regional banks, easing regulatory burdens on lending activities, facilitating loan restructuring and forbearance programs, and encouraging mergers and acquisitions among regional banks. In addition, investors and consumers should not lose sight of the opportunities and strengths of small-cap stocks. Despite their challenges, many small-cap companies have resilient business models, loyal customer bases, innovative products and services, and strong growth prospects. Some of them may also benefit from favorable trends such as digital transformation, e-commerce, renewable energy, and biotechnology. Furthermore, some analysts believe that small-cap stocks will rebound in the second half of the year, as they have historically done after periods of underperformance. In conclusion, small-cap stocks have struggled since turmoil in U.S. regional banks erupted in early March, with the Russell 2000 index down 7% since March 8. The banking crisis has posed significant challenges for small-cap companies and their lenders, as well as for investors and consumers. However, there are also reasons to be optimistic about the future of small-cap stocks, as long as the banking crisis is resolved and the economic recovery continues. The banking crisis that has rocked the U.S. economy since March has exposed the vulnerability of small-cap companies that depend on loans from regional banks. These banks have been at the center of the recent turmoil, as they faced a wave of deposit withdrawals, credit crunches and regulatory scrutiny. Some of them, such as Silicon Valley Bank, First Republic Bank and PacWest Bancorp, have collapsed or been taken over by larger rivals. Small-cap companies are those with a market capitalization of less than $2 billion. They typically have less access to capital markets and rely more on bank financing than larger firms. According to a report by Moody's Investors Service, small-cap companies accounted for 41% of the total bank loans outstanding in the U.S. as of December 2022. Many of these loans came from regional banks, which have a strong presence in local markets and specialize in serving small and medium-sized businesses. However, the banking crisis has disrupted the lending activity of regional banks, making it harder for small-cap companies to obtain or renew loans. Some of the reasons for this disruption are: regional banks have suffered heavy losses from their exposure to risky sectors, such as technology, energy, and real estate, which have been hit hard by the pandemic and the economic downturn. Regional banks have faced a liquidity squeeze, as depositors withdrew their funds amid fears of bank failures and sought safer alternatives, such as money market funds or large national banks. Regional banks have faced increased regulatory pressure, as the Federal Deposit Insurance Corporation, FDIC, and the Federal Reserve stepped up their oversight and intervention to prevent further bank failures and protect depositors. The reduced availability and higher cost of bank loans have put small-cap companies under financial stress, especially those that have high leverage, low profitability, or weak cash flows. Some of the consequences for these companies are: they may have to cut back on their investment, expansion, or hiring plans, which could hurt their growth prospects and competitiveness. They may have to sell assets, issue equity, or seek alternative sources of funding, such as private equity or bond markets, which could dilute their ownership or increase their debt burden. They may face default or bankruptcy risks, if they cannot meet their debt obligations or refinance their maturing loans. The banking crisis has thus created a vicious cycle for small-cap companies and regional banks. As small-cap companies struggle to survive, they may default on their loans or reduce their borrowing demand, which could further weaken the balance sheets and profitability of regional banks. As regional banks suffer more losses and face more regulatory constraints, they may tighten their lending standards or exit certain markets, which could further reduce the credit availability and increase the borrowing costs for small-cap companies. The banking crisis has not only threatened the stability of the financial system, but also the vitality of the real economy. Small-cap companies play an important role in the U.S. economy, as they account for about half of the private sector employment and contribute to innovation and entrepreneurship. The survival and recovery of these companies will depend on how quickly and effectively the government and the central bank can restore confidence and liquidity in the banking sector.